I'm the CEO of a $180 million B2B services company, private equity backed. We have 600 employees and a multi-state footprint. Revenue is flat for the first time in 7 years. Sales blames marketing, marketing blames product, and product says we're over-customizing for legacy clients. The PE board wants margin expansion in 2 quarters. I feel like the leadership team is aligned in meetings, but misaligned in behavior. I'm not sure what to do. I'm not sleeping well.
What I'm hearing is that revenue is flat for the first time in 7 years, and the PE board's expectation is margin expansion. And it sounds like it's not clear as to why this is happening. And in order to get a clear decision, it looks like we need to uncover the cause of why revenue is flat. So tell me, what changed before this inflection point?
What changed before the inflection point? Well, we shifted up market about 18 months ago. Larger contracts, longer sales cycles, and we reorganized sales into industry verticals, healthcare, financial services, and logistics, instead of geography. Because under geography, reps were generalists. We were winning mid-market deals, but not landing enterprise logos. And lastly, we tightened the pricing discipline because PE pushed us to improve margins. Now, on paper, all of those feel like the right moves, but we pulled 3 strategic levers at once. So maybe it was the combination that wasn't right. But here's what's bothering me. The pipeline looks healthy and the activity metrics look fine, yet deals are stalling late stage or coming in smaller than forecasted. And forecasting is less consistent. And culturally, there's more friction in the executive team than I've ever seen before. They're polite in meetings, but defensive in one-on-ones. And collaboration across product is uneven as well. Some of the legacy generalists didn't adapt well. So while the model should have improved performance, it may have fragmented accountability.
It was a smart move to reorganize around industry verticals, especially to pursue larger enterprise contracts where they expect specialists. However, since you have shifted up market, larger contracts often expect bigger discounts, even if just perceived. Yet you tightened your pricing discipline. What do you mean by that? That you are firm on price and aren't offering discounts?
Yes, essentially. Our CFO said margin leakage was out of control before. So we gave fewer discretionary discounts and put in place stricter approval thresholds.
It sounds like the new pricing is negatively impacting deal close. And you mentioned forecasting is less consistent. Did you just shift and lift the forecasting models from the geography days, or did you modify the models per an industry view?
We mostly shifted and lifted the forecasting model from the geography structure. So same stages, same probability weightings, and same close assumptions. We assumed enterprise deals would behave like larger mid-market deals, but they don't. Sales cycles are longer, procurement is heavier. And security reviews stall things. And lastly, deals bunch up at the end of the quarter. So yes, we changed the org design, but not the operating model behind it.
There is definitely an opportunity to evaluate the forecasting model to see how we can better tailor it towards an industry point of view to increase accuracy. But this is just a hygiene fix, so we'll leave it alone for now. It sounds like security reviews are a bottleneck. Deals thrive off of momentum, and this is a momentum killer. Exploring this can certainly help more deals go through and be less intensive than going after new deals. And when deals bunch up, it strains resources, therefore degrading attention to deal detail and customer needs. Exploring deal pacing and closing incentives would help increase focus and attention. But these are workflow issues. Let's see if we can find a heavier lever to pull on for margin expansion. What kind of training did you provide the legacy journalists? How many percentage-wise didn't adapt?
We ran a 3-month enablement push. We did industry positioning decks, vertical specific messaging, and a few enterprise selling workshops, but if I'm honest, it was more tactical than transformational. About 30% of the legacy reps are underperforming now. Another 20% are surviving, but not thriving. The top 25% adapted and are doing well, but the middle's a bit murky.
It sounds like training didn't convert well, with about half the generalists barely making it. There's more to do here, especially since this can impact retention, but this is a medium-term lever. So let's table this for the moment. Tell me more about what interactions on collaboration across product is uneven.
While the vertical heads are pushing for roadmap influence, sometimes in conflict with each other. So, for example, healthcare wants compliance-heavy features, logistics wants speed, integrations, customization, and financial services want security enhancements. And then product says, well, we can't build 3 roadmaps. And then sales says, well, you told us to go vertical, now support us. So I think we're overextended. And now there's tension in the executive meetings.
It sounds like there's a few areas to explore here. First, it makes sense now that there's increased misalignment from shifting into industry verticals. Everyone's customer has different needs. There might be a hard decision to make here. It might be time to whittle down what select industries you want to play in, choosing ones that have similar product needs. I personally feel like this is an impactful area to explore, as it'll bring everyone together, at least rowing in the same direction. And we can work on the quote unquote rowing technique once all the oars are aligned. Or secondly, we can explore pricing, which I personally see as an easy, fast fix. Since enterprise buyers expect negotiation, building this into the price before you set the price can help get the deals through the door. We can always look at the bottom line and do a cost analysis and optimization to improve margin later. Out of all the areas we've explored so far, which of these would you like to focus on this week?
The one that makes my stomach tighten is what you said about whittling down industries. Because that's not a tweak. That's a strategic narrowing. And it would absolutely hit short-term revenue. Right now, 45% of our revenue is in healthcare, 35% financial services, and 20% logistics. Healthcare and financial services both demand heavy compliance and security, and logistics is more integration and customization. If I'm honest, logistics has the longest sales cycle and lowest margins, but it's also where we thought growth upside was the strongest. If I narrow, I'm implicitly admitting the multi-vertical thesis was premature. The board might interpret that as instability. So yes, I think that's the real issue, but I'm afraid of the short-term optics. What would you push me to examine before making that call?
Yes, optics is important, but framing your message as how you're making trade-offs, balancing short-term gains with long-term stability and growth will be key to winning over the board. Since pricing, also a big lever, seems like an easy fix, let's leave that for next time. Let's explore the gut-wrenching issue here, so we'll walk away with some direction on this today. You weren't wrong in restructuring to the industry lens. Part of that is experimental because it's new. You don't know what industries perform best until you get data on them. Now that you have that data, you can make an informed decision on where to specialize. Since the bulk of your customers, 80%, are in healthcare and finance, you don't want to lose that core just now, even if it's flat, because we can adjust pricing and optimize workflow next to increase volume on these high margin deals. Additionally, it sounds like you might not have the financial flexion or balance sheet now to pivot to long close, low margin customers if revenues are flat. And I completely understand that this is a tempting area because it is high growth. But if you don't have the organizational capabilities to pursue it, given the problems you just shared with me, you won't win. So what's your instinct right now? In 5 years, what decision will you wish you made here?
My instinct is that we're trying to do too much. If I zoom out 5 years, I don't think I'll regret narrowing. I think I'll regret waiting too long to narrow. Healthcare and financial services are where we're the strongest, and we understand compliance. We've built muscle there. And logistics feels exciting, but it also feels like we're chasing growth before we've stabilized the core. 5 years from now, I want to say we built a focused, durable company.
I would listen to your instinct. I think if you partner with your FP&A expert and run a forecast model based on 3 scenarios, that will help you decide and show the trade-offs to the board. They would be 1, focus on 2 verticals and optimize margins. The second one would be go all in on 1 vertical. And the last one, stay multi-vertical, but expand product headcount to take on the feature request overload. You will need to consider for each industry the growth CAGR, market size, how much market share you have now, and the amount of market share you expect to bring in the next 6 months, as well as 3 to 5 years, and expected margin contribution, and run that against required product investment.
You'll have real numbers in front of you.
Thoughts?
Putting the solutions in math terms is hard to argue with. But I will admit something, though. Part of my hesitation isn't just financial. If I narrow now, I'm signaling to the org that we've overextended. Morale is already fragile. How would you advise communicating this internally so it feels strategic, not retreating?
I would stick to what you said earlier. 18 months ago, we made a deliberate move up market into industry verticals, and that was the right call. But this is where framing comes in. It expanded our enterprise credibility and sharpened our understanding of each sector.
What we've learned is this: depth wins before breadth. Don't dilute the core if the balance sheet can't support the investment in operational evolution. And that doing more low margin deals with the current workflow issues will only exacerbate those issues. So rather than spreading product and capital across 3 vertical businesses, we're choosing to concentrate where we have the strongest capability and margin profile. We are building the most durable version of this company, not the fastest expanding one. Let's have you drop 3 scenarios for the next meeting so we can get you roundtable input from the other execs before you present to your board. We can have the group prepare objections on each case in order to surface what scenario will likely win. Last question. What do you believe this situation is trying to teach you?
Well, I realize it's so easy to get lost in the cross-functional tension. It made it really hard to take a step back and look at the bigger picture. I was thinking tactically, what I could do to improve the tension and not strategically. I realized we changed structure without fully upgrading the operating model, and I was operating under the assumptions that everything would work just as well when we restructured. I probably should have reassessed that model earlier. And I think I've been trying to manage optics instead of managing capacity. This has really shown me to think bigger.
Yes, it's easy to get tied into the corporate drama when you really need to be the author of the bigger story. Next time you feel frustrated or encounter a complex problem like this one, remember to view it through a future-focused aperture. What is the right decision 5 years from now? Don't get caught up in the feelings of everyone, but rather why everyone is feeling the way they are.